Hey everyone, welcome back. You know why you're here, right? You want to know what's really going on in the economy, but who's got time to wade through all those reports?
That's where we come in. Today, we're giving you the inside scoop on the Fed's big meeting back on March 18th and 19th. Plus, we'll break down what Chair Powell had to say in the press conference right after.
We're talking about the March meeting minutes, folks, the transcript from that press conference, and we've even got some insightful analysis from, the experts out there.
It's like having a direct line to the Fed's brain trust. We're especially interested in how the new administration's policies, especially those tariffs, are playing into the Fed's thinking.
Absolutely. So we're on a mission here. What's the Fed's current take on the economy? How are they factoring in those tariffs, especially their impact on inflation? And ultimately, what does all this mean for growth going forward?
Buckle up, we're diving in.
Okay, let's start with the big picture. What kind of vibe were the Fed folks giving off about the overall economy back in March?
Well, they were actually pretty upbeat. They painted a picture of a fundamentally strong economy.
Okay, so good news.
Yeah, I'd say so. And a lot of it hinges on the job market. They reported an unemployment rate of just 4.1%, which is pretty darn low.
Mm.
Plus, they were seeing solid job gains, averaging 200,000 new payroll jobs every month.
So basically, lots of jobs out there for folks.
Yep. And importantly, they described the labor market as broadly in balance.
Meaning,
Well, it means they weren't seeing it as a major source of, upward pressure on inflation, at least not at that point.
right, because we know a tight labor market can push wages up, and then that can feed into overall inflation.
Exactly.
Speaking of inflation, that's always the big question, isn't it?
Always.
What was the Fed's take on inflation back in March?
Okay, so inflation had chilled out a bit from those highs we saw a while back, but they were still saying it was somewhat elevated.
Not quite where they want it to be.
Right. The total PCE inflation, which measures overall consumer spending, was up 2.5% for the year up to February.
PCE, so that's the Personal Consumption Expenditures Price Index.
Yep, that's the one. And then the core PCE, which strips out those volatile food and energy prices, that was running at 2.8%.
Both of those are still above their 2% target, right?
Exactly. So they weren't popping champagne just yet.
Got it. So jobs looking pretty good. Inflation's still a bit of a concern. What else caught your eye in their economic assessment?
Well, one thing they mentioned was that consumer spending, which had been growing like crazy in late 2024, seemed to be easing off a bit.
Interesting. So maybe people are starting to tighten their belts a little.
Could be. And here's the thing. When they looked at surveys of both households and businesses, they kept hearing the same thing. A whole lot of uncertainty about where the economy was headed.
That's kind of weird, isn't it? Strong economy on the surface, but everyone's kind of nervous.
That's the paradox, isn't it? But that uncertainty factor, that's probably why they decided to lower their growth forecast for 2025 to just 1.7%. They're basically saying, yeah, things look decent now, but we're not so sure about later.
All right, fair enough. So that brings us to the big question. What did the Fed actually do with interest rates at this meeting?
No big changes there. They decided to hold the federal funds rate steady in that 4.14 to 4.12% range.
So status quo on rates. But wait, didn't they tweak something else, something about their balance sheet?
You've got a sharp ear. Yes, they did make a technical adjustment to how they're reducing their balance sheet.
Okay, just to remind folks, balance sheet runoff is basically when the Fed lets its holdings of bonds shrink as they mature.
Exactly. They don't replace those maturing bonds, so their overall balance sheet shrinks. And starting in April, they decided to slow down that process. So instead of letting $25 billion in Treasury bonds roll off each month, they dropped that cap to $5 billion.
Why the change? Why now?
Well, they were super clear that this was a purely technical move. It wasn't some secret signal about a shift in monetary policy.
So not a reaction to inflation or anything.
Not directly, no. They said they were seeing signs of increased tightness in those short-term money markets. They basically wanted to make sure there were enough reserves in the banking system to keep things running smoothly, especially with the Treasury General account, the government's main checking account, seeing some decline.
So it's kind of like preventative maintenance for the financial system.
Exactly, making sure the pipes don't get clogged. It's not going to directly impact borrowing costs for most folks right away, but it's all about avoiding potential snags down the road.
Makes sense. Okay, what about their outlook for future interest rate moves? Any hints about where things might be headed?
Well, even though they kept saying how uncertain things were, remember that unusually elevated uncertainty Their median projections for interest rates stayed the same. They're still expecting the federal funds rate to be around 3.9% at the end of 2025 and 3.4% by the end of 2026. Those numbers haven't budged since their December projections.
It's interesting that they held those rate expectations steady, given all the uncertainty swirling around.
It does tell you something about their overall thinking, doesn't it? But like Chair Powell made clear, they're not locked into any predetermined path. They're going to be watching the data very carefully, seeing how the economic outlook develops and weighing all the risks. It's a data-dependent game, as they like to say.
Right. Let's talk tariffs. Everyone wants to know how those are going to play out. What did the Fed have to say about the new administration's trade policies?
Okay, so this was a big part of the conversation for sure. And one thing that really stood out was that both consumers and businesses, when they were surveyed, were already pointing to tariffs as a reason they expected prices to go up in the near term.
So the tariffs were already having an impact on people's expectations about inflation.
Yeah, definitely. People were anticipating higher prices even before those tariffs really started to bite. And Chair Powell, he acknowledged this straight up. He said something like, clearly some of it, a good part of it, is coming from tariffs.
But he didn't give like a precise number or anything.
Right. He pointed out that it's actually really hard to measure the exact impact of tariffs on inflation. He did mention that they were seeing a pretty noticeable increase in goods inflation recently.
So prices for stuff, like physical products, are going up. Makes sense.
Yep.
So what's the Fed's thinking on whether this tariff-driven inflation will be temporary or if it's going to stick around?
Their best guess at that time, their baseline scenario, was that it would be temporary or what they call transitory.
Okay, so it'll just kind of work its way through the system and then things will settle down.
That's their hope. But there are a couple of big ifs here. One is that those price effects from the tariffs need to move through the economy relatively quickly. And the other biggie is that longer-term inflation expectations need to stay anchored around that 2% target.
In other words, if people and businesses start thinking that inflation is going to be high for a long time, that can become a self-fulfilling prophecy.
You got it. And the Fed is very aware of that. And here's a little detail that might make you raise an eyebrow. In their summary of economic projections, they actually bumped up their inflation forecast for this year. And part of the reason they gave was, you guessed it, tariffs.
Huh. So they're already seeing some evidence that the tariffs are pushing prices up.
Yep. And their business contacts, they were starting to report either that their own costs were going up because of the tariffs or that they were more willing to pass those costs on to their customers. They were basically saying, look, if we got to pay more because of these tariffs, you're going to have to pay more too.
It's like a chain reaction, right? It starts at the tariffs, hits businesses, and then ultimately it's us, the consumers, who end up paying the price.
Exactly. And the Fed, they're acknowledging that the inflationary impact of these tariffs could end up being more persistent than they're currently projecting. Plus, it's really tough for them to tease apart how much of the inflation is coming from tariffs versus, other factors in the economy.
I bet that makes their job even harder, trying to get a clear picture of what's really driving inflation.
No kidding. Their staff actually built a placeholder into their projections. They're basically saying, okay, we know tariffs are going to have an impact, but we don't know exactly how big it'll be or how long it'll last. So we're going to factor in a range of possible outcomes. And generally, they're assuming that other countries will retaliate with their own tariffs, tit for tat.
Makes you wonder what all this is going to do to global trade.
Yeah, it's a whole other can of worms. But the Fed is clearly watching that aspect closely, too.
So tariffs, inflation, okay, got it. But what about the broader economic impact of all this tariff uncertainty?
That's a big one. The Fed was pretty clear that this uncertainty, it has the potential to put a damper on a whole bunch of stuff. Consumer spending, hiring decisions, and overall investment in the economy.
So businesses might get skittish and hold back on hiring or investing because they don't know what the trade landscape is going to look like in a few months.
Exactly. It makes it hard to plan for the future when you don't know what the rules of the game are going to be.
Makes sense. And it means this whole tariff thing could end up hitting us in two ways. Higher prices and fewer jobs. It's not a good combo.
Not at all.
Let's circle back to inflation expectations for a sec. How are tariffs playing into those?
Well, like we said, those short-term inflation expectations, the ones based on what people think prices will do in the next few months, those have gone up pretty much across the board. And when they ask people why they expect inflation to rise, tariffs keep coming up as a major factor.
So the expectation of higher prices, it's already baked in for a lot of people. But what about the long-term view? Are people expecting inflation to stay high for the foreseeable future?
Well, that's where it gets interesting. Most of the measures they look at, the ones that gauge longer term inflation expectations, those are still pretty much in line with the Fed's 2% goal. They did mention one survey, the University of Michigan survey, which showed some upward movement in longer term expectations, but they kind of brushed that off as an outlier. Still, they're keeping a close eye on it, just in case.
So they're really focused on making sure those long-term inflation expectations stay anchored, right?
Absolutely. If people start expecting higher inflation to be the new normal, it makes the Fed's job of controlling inflation way harder. It's all about maintaining credibility and keeping those expectations in check.
We've talked a lot about uncertainty today. It seems like that was the main takeaway from this whole meeting.
Yeah, uncertainty was definitely the word of the day. They even said it outright. Uncertainty around the economic outlook has increased. And they were pretty specific about what they were worried about: downside risks to employment and economic growth, and upside risks to inflation. And most of that uncertainty was tied to, you guessed it, the whole tariff situation.
And we already saw some real-world examples of that uncertainty playing out, like with those businesses putting hiring on hold.
Yep, lots of businesses were saying they were hitting pause on hiring because of all the policy uncertainty. They just didn't want to make big commitments when the future was so unclear. And the Fed specifically mentioned the auto industry as being particularly vulnerable to the risks from tariffs because their supply chains are so global and interconnected.
If one part of that chain gets disrupted, the whole thing can grind to a halt.
Exactly. And you know what's interesting? Chair Powell said that the Fed felt well positioned to wait for greater clarity before making any big policy moves. They're basically in watch and wait mode right now.
They want to gather more data before they decide what to do next.
Yep.
And just to be super clear, that adjustment they made to their balance sheet runoff, that wasn't about trying to nudge the economy in one direction or another, right?
Right. They kept hammering that point home. It was a purely technical adjustment based on what they were seeing in the money markets.
Okay, so we've got this interesting situation, the hard economic data, stuff like GDP growth and employment numbers, that's still looking pretty solid. But then you've got all this anxiety and worry reflected in those sentiment surveys. How did the Fed make sense of that?
Well, they acknowledge that there can be a disconnect between what people say in surveys and what they actually do in the real world. Someone might say they're worried about the economy, but they still go out and buy a new car. But the Fed is definitely watching for signs that those concerns are starting to show up in the hard data. If people start pulling back on spending or businesses stop hiring, that'll be a signal that the uncertainty is starting to have a real impact.
It sounds like the Fed's walking a tightrope here. They want to keep inflation in check, but they also don't want to do anything that could hurt growth or kill jobs.
That's the balancing act they're always facing. And with these tariffs run into the mix, it just gets even more complicated. They're really having to weigh those potential trade-offs very carefully. What if inflation turns out to be more stubborn than they think, and at the same time the economy starts to slow down? That could put them in a really tough spot.
Yeah, because their two main goals, maximum employment and stable prices, sometimes those can be at odds with each other.
Absolutely.
So big picture, the Fed in March, holding steady on rates, making a minor tweak to their balance sheet, and keeping a very close eye on the data, especially on inflation expectations. They're basically saying, we're ready to act if we need to, but for now, we're in wait-and-see mode.
Yep, that's a pretty good summary. Strong economy, lots of uncertainty, especially about those tariffs, and a Fed that's being cautious and data dependent.
All right, so for all you folks out there who are trying to make sense of this economy, what are the big things you should be watching in the coming months? What are those key indicators that will tell you how all these policies are actually playing out?
We'll definitely keep an eye on those inflation reports. Watch both the headline number and the core rate, the one that strips out food and energy. And pay attention to what's happening with consumer spending. See if those surveys of consumer confidence start to line up more with the actual spending data. And one more thing, watch the job market closely. Look at things like hiring rates and unemployment claims. Those are going to be really good indicators of the overall health of the economy.
Awesome. So if you found this breakdown helpful, if you're the kind of person who likes to cut through the clutter and understand what's really going on, hit that subscribe button and ring the bell. It really helps us out, and it means you'll never miss one of these deep dives.
Thanks for joining us. We'll see you next time.